Before we go anywhere near charts, numbers, or headlines, I want to slow this down for a second and talk to you like a real person. How are you actually doing? Not the quick answer you give out of habit, but the real one. These markets have not been easy. The constant swings, the endless opinions, the feeling that something big is building but no one can agree on what it is, that wears on people. I see it in the comments every day. Fear, frustration, confusion, but also something else that matters more: curiosity. A lot of you aren't here because you want a hot tip or a lottery ticket. You're here because you want to understand what's really happening underneath the noise. That's the entire reason this channel exists. You don't have to walk through this alone, and you don't have to outsource your thinking to anyone else. I read the comments closely, all of them, and what stood out wasn't panic about pullbacks or demands for price targets. It was people asking thoughtful questions, connecting dots, and wanting to learn how to see the market instead of being told what to think. If that's you, then pay attention, because the story the data is telling right now is far bigger than a single week's price action. We have to start with gold, because ignoring what just happened there would be irresponsible. Gold is sitting just over 5,000 in Western spot terms, and that number alone already tells you something unusual is going on. But the real signal didn't come from a chart. It came from the ground level, from physical markets, specifically China. After the Lunar New Year break, China reopened, and almost immediately reports began circulating that multiple gold shops across the country stopped selling bars entirely. Not delayed shipments, not come back next week. Refunds. Contracts that had already been signed were canceled and money was handed back. That matters. When a seller would rather return cash than source metal at any price, that is a physical shortage speaking in the clearest language possible. This isn't an analyst projection or a speculative rumor. It's a failure to deliver real metal in the world's largest gold-consuming country. Now put that into context, because this is where most people miss the plot. Gold reached these levels while China was effectively offline for an entire week. Traditional thinking says that when a major demand engine steps away, prices should soften. Instead, gold held firm and even pushed higher. It absorbed tariff headlines, policy uncertainty, and a brief bounce in the dollar without breaking structure. That alone should have raised eyebrows. And now China is back, demand is back, and supply can't keep up. The people who follow physical flows and demand data weren't surprised by this. They were waiting for it. Everyone else is still arguing about whether this is real or just headline-driven noise. Silver, meanwhile, is telling a different but equally important story. On the surface, you see a sharp move off the lows, roughly 16% in a very short window. To most observers, that already feels like a big move. The assumption is that the trade is crowded, that everyone is already in, that upside is limited. But when you look at the positioning data, that narrative collapses. Managed money long positions in COMEX silver, these are the speculative funds that chase momentum and exaggerate trends, are sitting at their lowest levels in roughly 20 years, lower than during the 2008 crisis. Let that sink in. Silver is rallying hard and the momentum crowd is barely involved. That's not how tops form, that's how moves begin before they become obvious. This is one of those moments where experience matters. When a market is moving with historically low speculative participation, any future inflow of momentum capital doesn't just add fuel, it changes the entire character of the move. What already happened starts to look small in hindsight. The early move isn't the event, it's the setup. And the people who understand that aren't chasing candles. They're watching positioning, structure, and the slow buildup of pressure that eventually releases all at once. Zoom out further, because the metals story doesn't exist in isolation. It's connected to a much larger shift happening across the global financial system. The US dollar's share of global reserves has now fallen to its lowest level in over 3 decades, sitting just under 57%. At its peak, it was over 70%. This isn't happening because central banks suddenly decided they don't like the dollar. It's happening because math and credibility matter over long time horizons. Persistent deficits, expanding debt loads, and the political reality around future obligations have forced reserve managers to diversify. This isn't ideological. It's pragmatic. Gold doesn't carry counterparty risk, and in an environment where trust is slowly eroding, that matters more than ever. Central bank and investor demand for gold has averaged roughly 610 tons per quarter over the last 2 quarters. Historically, demand levels well below that have been enough to drive meaningful price appreciation. We're not talking about marginal demand here. We're talking about sustained, documented buying pressure that exceeds the level typically required to push prices higher. Combine that with supply constraints that are now visibly breaking down in physical markets, and the price behavior stops looking mysterious. It looks inevitable. Now, this is where we reach the part of the story that most people aren't even looking at yet, but it may end up being the connective tissue that explains everything else. Quietly, over the last few years, a roughly $2 trillion private credit market has grown into a major funding source for large-scale infrastructure projects, particularly those tied to artificial intelligence. Data centers, computing capacity, power infrastructure, all of it requires enormous upfront capital. Much of that capital has come from private credit vehicles funded by pensions and insurance companies seeking yield in a low-rate world. One of the major players in this space manages hundreds of billions in assets and recently restricted withdrawals from a large retail fund. When a fund restricts withdrawals, it's not a cosmetic move. It raises immediate questions about liquidity and asset quality. The companies borrowing this money are often heavily leveraged, building infrastructure that may not generate meaningful cash flow for years. If revenue growth fails to meet expectations or even arrives later than projected, stress doesn't stay confined to a single sector. It moves through the credit system. At the same time, the U.S. housing market is flashing warning signs that are hard to ignore. Pending home sales have dropped to an all-time low, down more than 40% from their peak. Contract closings just fell sharply in a single month. This isn't a healthy slowdown, it's a freeze. Housing is deeply tied to credit conditions, consumer confidence, and bank balance sheets. When activity dries up like this, it tells you that something fundamental is tightening. Now look back at gold's volatility. It's at its highest level since the global financial crisis. High volatility in gold isn't about excitement, it's about uncertainty. It's the market pricing in tail risks before they fully materialize. This is exactly what Robert Shiller wrote about years ago, the idea that markets often begin repricing risk well before the broader public recognizes that anything has changed. By the time the story becomes obvious, the price has already moved. A lot of mainstream commentary still wants to frame this as tariff noise, or speculative excess, or a temporary reaction to headlines. That explanation feels comfortable because it doesn't require anyone to rethink the broader system. But the data doesn't support that comfort. It points to deeper structural shifts that are unfolding across multiple asset classes at the same time. I want to address something that came up repeatedly in the comments because it shows how much this community is evolving. Some people said technical analysis doesn't matter, and in a narrow sense, they're not entirely wrong. If your time horizon is long enough, fundamentals can carry you through a lot of volatility. But here's the part that gets missed. The most serious long-term capital in the world still uses technical systems. Not because they doubt the fundamentals, but because timing matters. There is a huge difference between being right eventually and being positioned correctly along the way. If you're operating on shorter time frames without technical analysis, you're not just at a disadvantage, you're guessing. Fundamentals tell you what, technicals tell you when. When those two align, conviction becomes unshakable. You're no longer reacting emotionally to headlines because you understand both the structural story and the price behavior expressing it in real time. That clarity doesn't come overnight, but it's attainable. I've seen people go from zero understanding to real confidence in under a year simply because they committed to learning how markets actually work. Here's the thing about technical analysis that almost no one explains properly. Price has memory. Markets don't move randomly. Certain patterns repeat at specific times, during specific sessions, within specific cycles. Whether you attribute that to algorithms, Institutional behavior or systematic positioning doesn't matter. What matters is that it's observable and consistent. When silver was forming key reversal structures, when bullish patterns were developing that contradicted the prevailing narrative, the people watching price structure saw it. They weren't waiting for permission from headlines. They were reading the market itself. That's the goal here. Not to build followers, but to build independent thinkers. People who can look at data, understand structure, and arrive at their own conclusions without needing reassurance from a crowd. That skill set matters more than any single trade, especially in an environment like this. Now, honesty matters, so let's talk about the resistance case. Gold at these levels with elevated volatility means sharp pullbacks are not only possible, they're likely. Fast markets move violently in both directions. Silver's recent rally means there are short-term traders sitting on profits who will sell into any credible negative headline. The private credit stress we discussed hasn't yet produced a visible collapse. And until it does, large pools of capital may stay in risk assets longer than many expect. Commodity bull markets are rarely smooth. Jim Rogers wrote extensively about how violent corrections are a feature, not a bug. They exist to shake out weak hands and test conviction. Silver can drop dramatically and still maintain a bullish structure. The key is whether it holds over meaningful time frames, not whether it avoids volatility altogether. The counterpoint is equally clear. Gold has outperformed the S&P 500 across virtually every major time horizon: 1 year, 5 years, 10 years, even 25 years. And yet the mainstream advisory industry largely ignores it. That's not accidental. It's a conflict of interest. When institutional flows are delayed, repricing doesn't disappear. It gets compressed. And when those flows finally arrive, moves accelerate. Look at silver equities. Many miners are sitting relatively close to their all-time highs, while spot silver remains far below its historical peak. That divergence matters. Equity markets often price future conditions before spot markets fully reflect them. It's an intermarket signal that experienced analysts recognize immediately. And then there's this. Silver has just printed 10 consecutive green monthly candles, breaking an all-time record. Think about that. The market endured massive forced selling, yet it continues to close higher on a monthly basis. That doesn't happen without deep, persistent physical demand underneath the surface. It tells you that even aggressive attempts to push price down are being absorbed. When you step back and connect the dots, the picture becomes clearer. Physical gold shortages emerging in China aren't isolated incidents, they're symptoms. A declining dollar reserve share isn't a political statement. It's a structural shift. Silver's positioning data shows a market moving without speculative excess. Private credit stress and housing weakness point to tightening financial conditions. These are not separate stories. They're different chapters of the same one. This isn't about hype. It's about logic. It's about understanding how capital moves when systems strain and confidence erodes. Every decision you make is your own. This is education, not advice. But if you take the time to learn how to read both fundamentals and structure, you won't need anyone to tell you what to think. This is The Real John, and I'll see you in the data.